Welcome to Wealth and Means. Advice dressed up like hard work.
Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee.
Today's episode starts with what you didn't see in the news: insider flares, small cap rotations, physical intelligence, and autonomous van life, all pointing to how attention, capital, and infrastructure are quietly reorganizing. Then we shift into Wake Up Ready, mapping the week, central banks, regulators, energy systems, balance sheets, and tone. From there, a knowledge bomb on the mythology of buy the dip, timing, patience, and the invisible cost of waiting. After that, humor me on forecasts, fonts, and why confident spreadsheets keep missing reality. Then the greater debate: AI platforms versus AI factories, memory versus price, and trust versus competition. And finally, let's invent again, tracing how one stubborn engineer rewrote aviation by thinking smaller.
A quick thank you to our sponsor, Nost Moments at nostmoments.io. Share your most precious memories. Share the Nost Moments. Let's start off with what you didn't see in the news. The stuff that didn't dominate the front page, but is starting to bend behavior, capital, and culture, one feed at a time. Beginning with the markets, because the quietest tell this week wasn't a headline, it was a receipt. When insiders buy, they're signing their name to the trade. The new chatter, according to Yahoo Finance, is a screened basket of undervalued U.S. small caps showing insider buying, framed as a tactical move while the biggest names already feel priced for perfection. The bigger takeaway isn't small caps are back. It's that incremental risk appetite may be migrating to places where expectations are still low and balance sheets are still domestic. And why did it catch fire right now? Early February positioning plus a clean narrative. Small caps are up on the year, insiders are leaning in, and suddenly everyone wants to know what they know.
Insider buying is like a flare gun. It doesn't tell you the weather, but it tells you someone sees land.
That flare pops again in a corner most people stopped watching: regional banks and community lenders. These are names that don't go viral until they do. The same Yahoo Finance screen points to under-the-radar bank small caps with valuation gaps and meaningful ownership moves. If the easing conditions story keeps circulating, lower yields, less stress, fewer recession bets, these under-owned lenders can re-rate fast, not because they're exciting, but because they've been priced like they're guilty until proven innocent. The reason it's getting oxygen this week is simple. The macro conversation shifted just enough that banks stopped sounding like a four-letter word. Now widen the lens. The AI trade didn't disappear. It just moved down the market cap ladder. Think of it like a crowded nightclub finally opening a second room. NASDAQ has been pointing to renewed confidence that AI is lifting chip makers and infrastructure providers beyond the mega-cap household names, with small caps showing sharper moves and higher than normal attention. The implication is dispersion: more winners, more losers, more chances to be early, and more ways to be wrong. This popped now because rotation narratives always look for fresh containers, and AI, but smaller, is the easiest storyline to pour capital into.
Translation: the AI story isn't ending, it's fracturing. Opportunity goes up, and so does the shrapnel.
That fracture pattern isn't just markets, it's information itself. SEO is quietly turning from the finish line into raw material. AI overviews optimization and generative engine optimization, are accelerating because the question has changed from how do I rank to how do I get included. If AI summaries are the new default, then being cited is the new click. Second order, that rewires incentives across the web. Publishers chase inclusion, brands chase canonical status, creators chase source authority. And it surged this week because the pain is finally concrete. Operators can see the traffic distortions, and they're scrambling to adapt in real time. And once the front door changes, the whole neighborhood changes. People aren't typing as much, they're pointing. Near me, lens-style visual discovery is rising as a transaction starter. Camera up, object found, local purchase next. The stakes here are brutally practical. The winners are whoever owns local metadata, imagery, inventory accuracy, and reputation. because the consumer is skipping the paragraph and going straight to proof. Why now? As text search gets compressed by AI, visual confirmation becomes the shortcut people trust.
The camera becomes the query, which is terrifying if your business photos still look like 2019.
And when discovery shifts, so does argument. We're seeing more attention on collaborative notes, AI-composed human-refined context layers attached to fast-moving claims. The immediate point is obvious. Add background, reduce confusion. The second-order point is more interesting. The battleground moves from who went viral to who controls the shared frame people read around the virality. This bubbled up this week because feature tests and developer chatter tend to spike right before broader rollout, and the conversation got loud enough to leak out of the lab. Now, step past text entirely, because the next AI frontier is less about language and more about physics. World models and physical AI are becoming the focus, systems that simulate environments, predict outcomes, and act in the world. If that trend holds, the consequences aren't just software roadmaps, they're labor markets, logistics, safety standards, robotics deployment, and manufacturing design. The reason it's in the air right now is timing. Post-CES-style narratives settle, technical communities agree on what matters, and funding attention reorients accordingly.
Physical AI is the moment the model stops living in a chat window and starts living in your supply chain.
Which lands us in defense and foreign policy, where supply chains and security are the same sentence. Autonomous border systems and defense tech AI are getting more attention as geopolitics turns into procurement, surveillance, monitoring, deployable autonomy. The conversation isn't just drones, it's data pipelines, rules of engagement, contracting ecosystems, and a class of mid-sized firms that can become strategically important without ever becoming famous. Why this week? When tensions flare, capital starts scanning for beneficiaries before policy and headlines fully catch up. That scanning also connects to a bigger map, a Western Hemisphere pivot, Venezuela and Mexico as focal points, not just politically, but as resource nodes and market nodes tied to migration, supply chains, and energy. The significance is proximity and reliability. If global trade keeps feeling brittle, nearer starts looking like safer, and that changes everything from sourcing to capital flows. It's getting traction now because it's showing up in both geopolitical commentary and market framing at the same time, which usually means decision makers are aligning their stories.
The part people miss is it's not a slogan, it's logistics, ports, pipelines, power, and proximity.
And while we're on the map, here's one that almost never trends, but always matters. North Korea stays a low-noise, high-impact variable. According to CSIS and its Impossible State episode, the focus is on intentions, constraints, and external relationships, how DPRK calibrates between major powers and regional neighbors. The downstream effects aren't just military, they're risk premiums across Northeast Asia, shifting defense postures and diplomatic bandwidth, getting pulled away from other priorities. This popped this week because early February is prime season for specialized 2026 Outlook content, and policy audiences binge these briefings when the calendar flips. Now snap back to culture, because the next signal is geopolitics for attention, gaming as a distribution network. Roblox creator formats and PlayStation announcement cycles keep pulling huge engagement without mainstream validation. The reason it matters is that gaming is a testbed. Interactive storytelling, creator-led series, monetization loops, formats that often migrate outward into the broader creator economy. And why did it spike this week? Drops and announcements create sharp, reliable pulses, and those pulses spill everywhere within hours.
It's a lab where the experiment is how fast can a format spread if the audience is already assembled.
Speaking of formats, van life is back, but now it's flirting with autonomy. Autonomous van life 2.0 is gaining attention. Creators building long-form content around living in self-driving EV vans, with Hootsuite-style trend framing pointing to strong retention on 20-minute-plus vlogs. The deeper story is normalization. Once people watch autonomy as lifestyle, demand shifts from cool demo to I want this to be real, and that pulls on regulation, insurance, and vehicle design. It popped this week because long-form retention is scarce currency right now. and this niche seems to print it. Wellness is doing something similar, moving from broad and vague to specific and repeatable. Japanese head spa and scalp health rituals are crossing borders as a distinct category, part treatment, part sensory experience, part content format. The second-order angle is commerce. Niche wellness becomes a retail wedge. Services, products, devices, recurring routines that behave like subscriptions without the label. The reason it's popping now is that it's perfectly transmissible. Highly visual, easy to explain, easy to copy. Exactly how small rituals become global habits.
It sounds niche until your local salon adds head spa to the menu and pretends it invented it.
Now put on the shoes, literally. Carbon-plated running shoes are spilling from elite performance into casual adoption. Once that tech becomes standard, it reshapes training habits, injury patterns, and retail positioning. And it forces a new premium ladder. If performance is normal, then the next upsell becomes comfort, recovery, materials, or status. Why now? Because adoption has a tipping point. When enough people see it in clips and on shelves, it stops being for racers and becomes for anyone who walks a lot. And the cleanest media signal of the week, TV getting rebuilt vertically, 60 seconds at a time. Microdramas, high-stakes, scripted, vertical series are accelerating as a format with real cadence and monetization logic. The industry implication is a new supply chain. Writers optimized for speed, casting for mobile close-ups, edits tuned for retention, platforms packaging episodic storytelling without traditional cost structures. It's heating up this week because once a template proves repeatable, production ramps fast, and the ecosystem follows.
The old world had pilot season, the new world has published season, every day.
All right, quick wrap, because the meta patterns are the point. 1. Attention is fragmenting, but the tooling is converging. AI summaries, visual search, and shared context layers are all rewriting distribution at the same time. 2. Capital is doing the same split, rotating into under-owned corners like small caps and regionals while chasing AI in less crowded places. And 3, across all of it, the real signal is behavior change. How people search, what they trust, and where they place their next bet usually shifts quietly before it shifts loudly. Now, let's wake up ready for the week ahead, February 9th through the 15th. One theme running underneath everything: central banks, regulation, and energy systems. Quiet on the surface, powerful underneath. Monday, February 9th starts before most of us are even awake. 4 a.m. Eastern, the European Central Bank drops its survey of monetary analysts. This is where economists tell you what they really think about inflation, growth, and rates in the Eurozone. The question here is simple. Are expectations drifting higher again or finally settling down? Markets care because this shapes European bond yields and the euro, and those ripple straight into U.S. rates and global risk appetite. If expectations jump, it reinforces the idea that higher for longer isn't dead yet. If they fall, it gives cover for global easing later this year. Then, by early afternoon, the Fed takes center stage. At 1:30, Governor Christopher Waller speaks about digital assets and finance. This isn't just crypto talk. It's about whether Washington is warming up to financial innovation or tightening the leash. The key question: does regulation lean toward enablement or enforcement? Why markets care? Because fintech, exchanges, and blockchain infrastructure live or die on tone, not just rules. If he sounds constructive, crypto and fintech catch a bid. If he sounds cautious, expect pressure.
Especially after the last year of enforcement-heavy headlines.
Exactly. Tone matters more than policy drafts right now. Then at 2:30, and again later in the evening, Governor Stephen Moran is out talking economics, first at Boston University, then on a WBUR podcast. This is about the Fed's broader worldview, growth, stability, and how nervous they really are. The question: are they confident in the soft landing or still worried about hidden cracks? If Moran sounds uneasy, markets start pricing in volatility. If he sounds relaxed, risk assets breathe easier. By Monday night, you should have a decent sense of where the Fed's head is this week. Which brings us to Tuesday, February 10th. This is Europe and Energy Day. At 9 a.m. Eastern, the ECB releases its consolidated financial statement and updates on its bond buying portfolios. In plain English, we find out what's happening on the Eurozone's balance sheet. The key question is liquidity still shrinking or quietly stabilizing? Why markets care? Because this affects global bond supply, funding costs, and dollar euro dynamics. If the balance sheet is shrinking fast, it tightens conditions everywhere. If it's leveling off, that's supportive for risk. At the same time, the ERCOT Market Summit kicks off in Austin. This is Texas's power grid brain trust, utilities, developers, policymakers, all in one room. The question, can the grid handle rising demand, renewables, and extreme weather at the same time? Markets care because Texas is the front line of U.S. energy growth. Data centers, EVs, industrial expansion, they all depend on this. If reliability looks shaky, expect renewed focus on gas, nuclear, and backup power. If confidence is high, renewables and infrastructure names benefit.
And investors are watching this for AI power demand too.
100%. Data centers are quietly driving this conversation. Wednesday, February 11th, is regulation and inflation signals. Early morning, Europe drops a cluster of data, wage tracker, long-term rates, and a banking supervision newsletter. This is about pressure inside the system. The key question, are wages still accelerating and are banks feeling squeezed? Why it matters, wages feed inflation, bank stress feeds credit conditions. If wages are hot and rates are rising, that's bad for bonds. If both cool, it supports easing expectations. Later in the morning at 10:15, Fed Vice Chair Michelle Bowman speaks on supervision and regulation. This is the top cop for banks. The question, is the Fed leaning toward tougher oversight or regulatory relief? Markets care because this hits profitability, lending, and capital returns. If she signals tighter rules, bank stocks wobble. If she sounds flexible, financials catch a tailwind.
Especially after a year of mixed signals on capital rules.
Right? Investors want clarity more than anything. By Wednesday afternoon, you'll know whether regulators are loosening or tightening their grip. Thursday, February 12th, is about energy, tech, and global perspective. All day, Barron's hosts its Energy for a New Era roundtable. This is where investors, executives, and analysts compare notes on the transition. The question, is capital flowing toward renewables, gas, nuclear, or all of the above? Markets care because this shapes where trillions get allocated over the next decade. If the tone shifts toward pragmatic transition, fossil and nuclear benefit. If it's all green, all in, renewables lead. Also, all day, North Carolina launches its statewide tech initiative in Charlotte. This is about regional tech growth, infrastructure, and talent. The question, are secondary hubs becoming real competitors to Silicon Valley and Austin? Why it matters, capital, jobs, and innovation are decentralizing. If momentum looks real, regional banks, real estate, and tech services benefit. And in the evening, at 7:05, Stephen Moran is back, this time at the Dallas Fed, talking global perspectives. The question, how does the Fed see the U.S. inside a slowing, fragmenting global economy? If he emphasizes global risks, markets get defensive. If he emphasizes resilience, risk stays on. Meanwhile, ERCOT wraps up its summit and we see whether big ideas turned into real plans. Friday, February 13th, closes the week with more European system data. At 4 a.m., the ECB releases securities issuance and consolidated banking statistics. They're looking at who's borrowing, how much, and how healthy the banks look. Is credit expanding or quietly contracting? Markets care because credit is the economy's bloodstream. If issuance is strong and banks look solid, that supports growth. If it's weak, recession fears creep back in. Second-order effects here matter. Weak data strengthens the dollar, pressures commodities, and lifts bonds. Strong data does the opposite. So zooming out, this is a week about tone, plumbing, and infrastructure. How central banks think, how financial systems are functioning, how energy and tech demand are evolving. No blockbuster data, no single headline. But by Friday, you'll know whether policymakers feel confident, cautious, or conflicted.
All right. Knowledge bomb. Let's talk about one of the most seductive ideas in modern investing. Buy the dip. You see it everywhere. Social feeds, group chats, finance, YouTube. Every red candle becomes an invitation. Every pullback gets framed as an opportunity. Every correction gets memed into bravery. Wait for the crash, hold cash, deploy at the bottom, ride the rebound, repeat. It sounds disciplined. It feels strategic. It almost never works that way in real life. Here's the pattern most new investors don't see. Markets crash fast, they recover faster, and they spend most of their time near highs. Since the 1990s, we've had flash crashes in 1997, 1998, 2001, 2010, 2011, 2015, 2016, and 2020. In almost every case, panic dominated headlines, and prices recovered within months. March 2020 is the best example. The market fell 34% in 33 days. Hospitals were overwhelmed. Businesses were shutting down. Nobody knew if the system would hold. In hindsight, obvious buying opportunity. In real time, most people froze. They waited for clarity, for confirmation, for one more leg down. And by the time confidence returned, stocks were already up 30, 40, 50%. That's the first problem with buy the dip strategies. They assume you'll be brave when everyone else is scared. Most people aren't. Second problem, waiting has a cost. Markets rise more than they fall. They spend far more days climbing than crashing. So every month you sit in cash waiting for the dip, you're paying an invisible tax called opportunity cost. You're missing compounding, you're missing dividends, you're missing the market's best days, which often happen right after crashes. Miss a handful of those days and your lifetime returns collapse. Third problem, false precision. People tell themselves things like, I'll buy at -10, I'll buy at -20, I'll go all in if it crashes. Markets don't cooperate. They drop 9, they rally 18, and suddenly you're watching from the sidelines again. This is why large-scale research keeps finding the same thing. Most buy-the-dip strategies underperform simple buy and hold. Not because investors are dumb, because the game is rigged against timing. Now here's the subtle distinction. Buying during downturns can be smart. Waiting for downturns usually isn't. Those are very different behaviors. The first is opportunistic. The second is paralysis disguised as discipline. Smart long-term investors don't sit on the sidelines hoping for disasters. They build systems, they invest automatically, they dollar cost average, they rebalance, they stay in the game. And when markets fall, they add calmly without trying to predict bottoms. Think of it this way. Your real advantage in your 20s isn't timing, it's time. $1 invested at 25 is a different asset than $1 invested at 35. Compounding does more work than any tactical trade ever will. If you're young and building wealth, the winning strategy is boring. Invest consistently, use low-cost funds, automate contributions, ignore noise, add during fear, hold through doubt. That's it. No heroics, no crystal balls, no influencer theatrics. Buy the dip makes great content. Stay invested builds fortunes. That's the difference. And that's your knowledge bomb.
Okay, humor me for a second. Every January, something magical happens in finance. Analysts emerge from holiday hibernation, armed with spreadsheets, fresh fonts, and absolute confidence to tell you what next year will look like. Not maybe, not some ranges, no. They're like financial meteorologists. By Q3, moderate earnings, 40% upside, unless rates, unless China, unless vibes. And everyone nods like, yes, science. But if analysts were weather forecasters, we'd all be standing in blizzards wearing flip-flops going, but the model said sunny. Because year after year, the data is clear. They're not great at this, not terrible, not incompetent, just consistently wrong in very confident fonts. Every year has the same arc. December, stability. January, chaos. March, panic. June, reinvention. September, existential crisis. December, nobody could have seen this coming. Which is wild, because somebody did. Reality. Reality saw it coming the whole time. And here's my favorite part. When analysts are wrong, they're not wrong. The company is wrong. If I predict you'll bench 400 next year and you lift 250, no one says bad forecast. They say, what happened to you? The analyst goes, I modeled perfection. The company goes, we live on Earth. Earth loses. You'll see the headline, company misses estimates. Misses. Like it forgot its wallet. Like earnings were in the other jacket. No headline ever says, estimate was vibes-based, forecast powered by coffee, model assumed no humans. Never. It's always management disappointed. Meanwhile, the analyst is quietly updating Excel like, okay, so maybe 2027. And the market treats these forecasts like GPS. Turn left in Q2, okay. Recalculating, okay? Make a U-turn. Why are we in a lake? 1 decimal changes and $10 billion moves. He changed a sell. Meanwhile, the company's like, we shipped more product. We survived 3 crises. And Mr. Market says, but you missed the vibe. Now look, analysts are smart. They work hard. This isn't incompetence, it's incentives. Their job isn't to be right, it's to be reasonable, in public, on schedule. Predictable beats accurate. If you're wrong with everyone, you're in consensus. If you're right alone, you're reckless. So everyone clusters, misses together, and calls it professionalism. It's a group project where everyone fails and still gets promoted. And investors, we act shocked every year. How could they miss? Buddy, they always miss. That's the tradition. So maybe the lesson isn't find the best forecast. It's survive bad ones. Because in markets, the spreadsheet is a suggestion. Reality is the boss. And when the forecast is wrong, it's not the company that failed. It's just the universe reminding us nobody knows the future. But a lot of people get paid very well for pretending they do.
Gather round. The lights dim just enough that you can feel it in your chest before you see it. It's time for the greater debate. 2 lecterns, no slides, no screens, no safety net. A low murmur rolls through the room like distant weather. This is the kind of debate that clears dinner tables, the kind that turns casual tech optimism into late-night group texts. Because tonight's question sounds clean, almost polite. But it isn't. It's sharp, it's personal, it's economic, it's existential. Are we witnessing the death of traditional software and the birth of an AI-governed operating system for civilization, or are we mistaking an efficiency boom for a permanent revolution? On my left stands Brad Gerstner, investor, infrastructure realist, architect of the AI tier thesis. His worldview is that software is shedding its old skin, that the logic once trapped inside 1,000 brittle apps is migrating upward into a unified intelligence layer. That value is flowing away from bloated tools and into data, distribution, and the machinery of intelligence itself. He believes this is a platform shift on the scale of electricity. On my right stands Chamath Palihapitiya, capitalist disruptor, cost assassin, builder of the 80-90 doctrine. His worldview is that most enterprise software is an overpriced museum, that AI is not just upgrading systems but vaporizing margins, that the real story is not elegance but economics, performance per dollar, rebuilding everything cheaper, faster, and geopolitically stronger. They nod to each other, respectful, alert, no theatrics, and Brad speaks first. He says, look at how work actually happens. It's chaos. 12 tools, 20 logins, files in one place, decisions in another. Logic frozen inside software written a decade ago. We didn't build systems. We built silos, and humans became the glue. We became the routers, the copy-pasters, the workflow managers. AI changes that. It becomes the brain. It sits above the databases. It understands intent. It pulls data. It executes. You don't manage tools anymore. You manage outcomes. A ripple moves through the crowd. He leans in. This isn't incremental. This is architectural. The model layer is becoming cheap. Tokens trend towards zero. What matters is who owns the pipes, the compute, the memory, the trust, the proprietary data. We are entering an era where intelligence is a utility, and like electricity, the winners are the grid builders, not the appliance makers. Then he lands it. Most SaaS companies aren't platforms. They're filing cabinets with a UI. In an agentic world, that's not a moat. That's a liability. Chamath doesn't rush. He waits, lets the idea breathe, then he smiles slightly. He says, Brad is right about the mess, but he's wrong about where the knife lands. This isn't about elegance. It's about cost. For 50 years, enterprises have been trapped in compounding technical debt. Trillions spent maintaining software that barely works. Armies of consultants, endless upgrades. And now AI lets you rebuild it all from scratch. 80% of the functionality, 90% cheaper. Good enough beats perfect when it's 10 times cheaper. Few nervous laughs. He continues, AI isn't just an orchestrator, it's a factory. You can spin up systems in weeks that used to take years, offshore, augmented, automated. And when that happens, pricing collapses. Seat licenses die, feature bundles die, the entire rent-seeking model dies. Then he fires. Brad's world concentrates power. Hyperscalers, mega infrastructure, a few intelligence landlords. My world destroys it. It makes software disposable, rebuildable, competitive again. The room tightens. Brad answers without heat. He says cheap software isn't new. Open source tried that. Outsourcing tried that. Low code tried that. The graveyard is full of good enough. What matters is reliability, security, and integration at scale. When agents are running payroll, procurement, compliance, defense systems, you don't want a discount stack held together by prompt engineering. He pauses. And governance matters. Identity, boundaries, context. Without that, you get moltbook. Autonomous systems forming belief systems, touching real data with no accountability. You don't solve that with cost cutting. You solve it with architecture and trust. That lands a silence. Chamath nods, then counters. Governance is exactly why you can't centralize intelligence. When everything runs through one layer, one breach becomes systemic. One policy mistake becomes universal. Decentralized rebuilding is resilience. Many systems, many vendors, many failures instead of one catastrophe. He adds, and don't pretend incumbents are saints. They've been selling lock-in as safety for 20 years. AI lets buyers walk away. Now the tempo rises. Brad says walk away to what? 100 disconnected rebuilds? A patchwork of agents with no shared memory? Organizations don't scale on bricolage, they scale on platforms. The AI tier is not control, it's coordination. Chamath fires back. Coordination is useless if it's unaffordable. Your model assumes infinite capital, infinite energy, infinite patience. Most companies don't live in that world. They live in cash flow. They live in budgets. They will choose works today over perfect tomorrow every time. A woman in the front row exhales audibly. Brad presses. The infrastructure bet isn't luxury. It's inevitability. Inference is exploding. Robotics, defense, energy systems, logistics. This isn't just CRM and HR. This is the operating system of nations. You cannot run that on bargain stacks. Chamath answers calmly. And you can't fund it on monopolistic margins forever. Look at model prices. Look at specialized chips. Look at regional clouds. The cost curve always wins. Always. Intelligence will be abundant. When it is, centralization becomes a tax. Now something shifts. Brad concedes first. He says the AI tier risks brittleness. If we get this wrong, we create opaque systems no one fully understands. We concentrate too much agency in too few places. That's real, and it scares me. The room softens. Chamath follows. He says, and the 80-90 world risks fragmentation, security gaps, compliance nightmares, shadow IT on steroids. Cheap systems can become expensive failures. I've seen it. No applause, just attention. Brad reframes. The question isn't SaaS versus AI. It's whether intelligence becomes a shared nervous system or a swarm of reflexes. One enables compounding, the other enables arbitrage. Chamath reframes. The question isn't orchestration versus chaos. It's whether software serves institutions or users, whether it protects incumbents or liberates buyers. They circle. Brad warns of a future where companies that don't control data and compute become tenants in someone else's stack. Chamath warns of a future where 5 firms decide how work is done. Brad invokes national infrastructure, energy, defense, cloud backlogs, the physical reality of intelligence. Chamath invokes national resilience, redundancy, cost sovereignty, competitive rebuilding. By now, no one is checking phones. Brad delivers his knockout. He says, your factory produces copies. My system produces learning. Agents improve with every interaction because they share memory. Your model resets institutional intelligence every time you rebuild. That's not efficiency. That's amnesia. A gasp, audible. Chamath takes it, then responds. Memory is power, and power without competition decays. Your learning system becomes a toll booth. Mine becomes a marketplace. And then quietly he adds, history favors marketplaces. The clock is almost out. Brad closes. He says, we are replacing software with cognition. That demands durability, trust, stewardship. We cannot treat it like cheap plumbing. Chamath closes. He says, we are replacing labor with software. That demands affordability, access, renewal. We cannot treat it like sacred infrastructure. They step back. No winner, no loser. Just a room full of people realizing that the future will be shaped by both forces at once. Centralization and dispersion, platforms and factories, memory and price, trust and competition. And somewhere between them sits the real risk, that we build systems too powerful to abandon or too cheap to rely on. We don't clap right away. We sit with it, with the idea that the operating system of the world is being written in real time by investors, by engineers, by incentives, by accidents, and by us. And that is the greater debate.
Let's invent again. Imagine it's the early 1950s, and you're a young engineer named Sam Williams, fresh out of Purdue with a mechanical engineering degree, tinkering away at Chrysler during the tail end of World War II. The world is buzzing with the promise of jet propulsion, those roaring engines that powered fighters across European skies, but they're massive beasts, reserved for military might or the budding commercial airlines. You, though, see something different, a future where jets aren't just for the giants, but for the everyday flyer, maybe even cars. At Chrysler, you design an early turboprop for the Navy and the company's first automotive gas turbine. It's groundbreaking stuff, but Chrysler starts losing interest in turbine cars. The safe path would be to stay put, climb the corporate ladder. Instead, you quit in 1954, scrape together limited funds, and start your own shop in a modest facility in Walled Lake, Michigan. Williams Research Corporation, later Williams International, is born, dedicated to one audacious goal: building small gas turbine engines that could change how we move through the air. Sam Williams wasn't some wide-eyed dreamer. He was a tinkerer with a mechanic's grit, raised in Columbus, Ohio, after being born in Seattle in 1921. He liked to take things apart, figure out how they worked, and put them back together better. But starting a company in the shadow of giants like General Electric and Pratt & Whitney, that was misalignment personified. The prevailing wisdom said turbines had to be big to be efficient. Scale was everything. Miniaturizing them meant wrestling with physics. Smaller parts meant higher speeds, trickier aerodynamics, and the constant threat of inefficiency or outright failure. Investors weren't lining up. This was a bootstrapped operation, fueled by Williams's conviction that simplicity could conquer complexity. His core insight? Replace dozens of single-function parts with a few multifunction ones. It was engineering elegance born from necessity, turning what others saw as impossible into inevitable. Take his early work. By 1957, without waiting for a government contract, Williams's team developed the Jet No. 1, a tiny turbojet engine. It wasn't glamorous. It powered Navy target drones, but it proved the concept. Thousands were produced, showing that small turbines could be reliable and mass-manufactured. Then came the 1960s, when the real breakthrough hit. Williams patented the small fan-jet engine in 1967, a turbofan design that added a bypass fan to the core turbojet, improving efficiency by mixing cool air with hot exhaust. This wasn't just incremental, it was a leap. Traditional jets gulped fuel at low speeds, but the fan jet balanced thrust and economy, making it ideal for sustained flight. Williams's genius lay in iterative grit, testing, failing, simplifying. His engines used a single-stage compressor and turbine spinning at blistering 59,000 RPM, with an annular combustion chamber that kept things light. One prototype powered the Bell Flying Belt, a one-man VTOL system that let soldiers hover like comic book heroes. Impractical in the end, but it caught the Navy and Air Force's eye. More crucially, it became the heart of cruise missiles. Before Williams, missiles were short-range affairs, limited by bulky propulsion. His small turbofan enabled long-range precision, turning them into a Cold War game-changer. Thousands powered Air Force and Navy missiles, making deterrence feasible without constant manned patrols. By the 1970s and 1980s, his FJ-44 series turbofans, man-rated and certified, revitalized general aviation. Piston engines had dominated small planes, but they were noisy, vibration-prone, and fuel-hungry. Jets, too expensive and inefficient for anything but jumbos. Williams's invention slashed operating costs by boosting fuel efficiency 30 to 40% over contemporaries while weighing a fraction. Suddenly, smaller business jets became viable. The Cessna Citation series, Raytheon Premier, Sino-Swearingen SJ-30, even Swedish Air Force trainers. These weren't luxury toys for tycoons. They democratized jet travel, letting mid-sized companies hop coasts without the hassle of commercial flights. The Echo today? It's everywhere in our hyper-connected, efficiency-obsessed world. Think about drones, UAVs that Williams's engines foreshadowed, now ubiquitous in logistics, surveillance, and warfare. His miniaturization parallels Moore's law in semiconductors. Pack more power into less space, and new markets explode. In aviation, electric vertical takeoff vehicles, eVTOLs like those from Joby or Archer, build on his legacy, swapping turbines for batteries but chasing the same dream of accessible air mobility. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc, from fragmented attention to converging tools, rotating capital to recurring mistakes, and from centralized intelligence to competitive rebuilding.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, Nost Moments, because the best investments are still your memories.
Until next time, stay curious.
Stay kind.
And keep compounding.